I'm Charlotte McLeod with investingnews.com, and here today with me is Josef Schachter, president and author at the Schachter Energy Report and a 40-year veteran of the industry on both the buy and sell side. Thank you so much for being here. Great to have you.
My pleasure, Charlotte. Good to be with you.
Really good to be speaking with you. It's our first time talking, so we've got a lot to go over for sure today. We're going to take a look at oil and gas in 2025, but before we go there, I want to take a brief look back at 2024 and ask you if there are any trends that stood out to you this past year, things that surprised you. What would you want investors to take away about 2024?
Well, it was almost like a tale of two cities, the first half of 24 and the second half of 24. In the first half of 24, we got up as high as $87.67 US for WTI. And then in the second half of the year, the first half of the year, the perception was that the industry was in a short supply and that there was going to be much higher prices, and many of them were talking over 90. And I started seeing the U.S. data, and the U.S. data was showing that demand was lower than the prior year. So we were seeing weakness in demand as people were squeezed by their home budgets, and so they weren't using as much energy as they had, because food prices were up, mortgage prices were up, everything related to home ownership, education, etc., clothing, we're squeezing them. And so we started saying there's a risk of sub $70 US for WTI. That did occur in September of 2024, and we went down to $65.27. I'm just looking at the chart on my left, and we've been in that 65 to mid 70s range since then. We're now about 70 and a quarter today, and I think we're going to probably test the lows in the coming weeks because we're seeing more weakness out of China data, and so there's an issue there. The other thing is OPEC has been increasing production. They keep on talking about limiting production, but the data that came out in their December report, which there's a monthly report that OPEC calls the OPEC Monthly Oil Market Report, came out on December the 11th, and they showed that production increased by 104,000 to 26.7 million barrels. So OPEC was lifting production as demand was coming down, and that's why we've seen prices near term weaker. And of course, the China data has been subdued. Where there's a positive for 2025 is U.S. demand is now rising. If you go to there's a report that comes out by the EIA, the Energy Information Administration in the U.S., which is called the Weekly Petroleum Status Report. Usually comes out on Wednesday, except during holidays, and it's now showing demand increasing this year versus last year. That's the first, we started seeing that about a month or two ago, and I started getting more positive, saying we're going to have maybe a test of the low because of China, but once that's over, everything looks good for 2025, and I'm looking for higher prices. Most people on the analytical side are using $70 to $74 for their forecast for 2025. And I'm in the camp that I was using, low 70s in 2024 when they were in the 80s. I'm now looking for potentially $80 to $82 for the average in 2025. And I can go by quarter. I think the first quarter might be as low as 68 to 78, rising in the second quarter, 74 to 84. And then in the second half of the year, I think we'll see good economic growth in the States. China will be doing better because I think their stimuluses will finally kick in. And the Asian countries near China, which are hurting because China's weak, and a lot of them work with China, they're going to do better. So I'm looking for 78 to 86. But the big thing is, I think we're looking at 90s on a consistent basis in Q4 with a range of 84 to 96. So going from $70 to $90 Q4 of this year to Q4 of next year, that will wake everybody up. Energy's been a very poor performer. Tax loss selling has been pretty horrible right now. For most people, if they look at their stock quotes, they'll see that. And we've seen that also for materials. Materials hasn't really done very well this year either. But I think in 2025, commodities will be an outperformer relative to other subgroups of the S&P TSX or the S&P 500. And I think we're going to see very strong performance, especially if I'm right, with $90 WTI. I think there's a lot of stocks out there that could be 50% or more to the upside between the end of this year and the end of next year. So I think it's an area that we think, after being cautious, we're now firmly in the bull camp, and we're thinking people should be taking advantage. And we've been writing about this in our reports. Take advantage of the tax loss selling that's going on right now, and because we think that these are bargains that you'll be very happy to own a year from now.
Yeah, we're definitely in the thick of that tax loss selling right now. So that gives us a really good look at 2024 and a little bit of what's coming in 2025. So we'll try to unpack some of the different topics that are going to get us to those higher prices. There's a lot to get into, but where I thought we could start is, I know a lot of people have questions about Trump's upcoming second term in the US. So there is a lot of optimism, I think, about drill baby drill and his energy secretary appointment, but then many questions about tariffs, confusion about the promise that he's going to cut energy prices in half. So I wondered, this is a broad question, but if we could take a look at what Trump could mean for oil and gas when he is inaugurated in January.
Yeah, the U.S. From the EIA data is producing about 13.6 million barrels a day, which is record production. And ExxonMobil's talking about between now and the end of the decade doubling their production of their, on their lands, because of new technologies, of better drilling capabilities, more, better frac techniques, all the things they're doing. And so I think we're going to be looking at potentially 2 to 3 million more barrels coming out of the States in the next, between now and the end of the decade, which is a pretty big increase. But a lot of it takes time. Some of the things you need is regulatory changes. So lands that are federal lands, especially in New Mexico, that Biden has not allowed to be drilled, they need to have those regulations changed. Once the regulations change, then companies can go in there and do their seismic and, sign up for the land, deal with the landowners, in terms of royalties. And then they need infrastructure. So just because you drill a well and you find a reserve, if you can't bring it to market, that's a problem. So infrastructure becomes an issue. And the other area, of course, is going to be the Gulf of Mexico. Gulf of Mexico historically has been very attractive. It really doesn't get the attention because of its federal lands. And Biden, again, has held people from drilling. And then the other wild card is Alaska. At one point, Alaska was producing 2 million barrels a day. Now it's 500,000 barrels a day, almost flatline. They want to get into UNWRA. They want to get into other areas. And again, Trump has said that he would support opening up federal lands for drilling. So, it's going to take time, number one, for the regulatory changes to go through. Then the companies have to do their technical work. Then they go and, arrange to get access to the lands. Then, of course, you need the equipment brought in. And, of course, bringing equipment up to Alaska all the way up there is not the easiest thing, especially when there's not a lot of rigs in the area right now. So all of that takes time. But once they do, I think there's a chance, not in 2025 for an increase in production, maybe a little bit because the Permian, things get better on the Texas side, but it'll be for New Mexico and Gulf of Mexico and Alaska, probably a 2026, 27. But by the end of the decade, we could see 3 million more barrels. Now, the key is the companies won't spend that money, and it's very expensive to drill in Alaska and offshore Gulf of Mexico unless the rates of return there. And the companies now are focused on a return to shareholders. And so they're going to decide, do we use our free cash flow to buy back our stock because we think it's cheap? Do we pay dividends or special dividends, or do we drill and grow? And the only way they're going to drill and grow is if the economics are there. So if Trump comes in and says, okay, the price of gasoline is $4.50, it's going to be $2.50, nobody's going to drill for oil because they're not going to get the economics for the product to be supplied at $2.50 a gallon. So to me, the drill baby drill can work, but prices going down 50% cannot. Now, tariffs is an interesting thing. I think America in the beginning, after it became a country, did not have income taxes. They had tariffs because they were trying to build up the industry of America. Same story we're hearing right now from President Trump, America first. We want to have our own, we want to do our own semiconductors. We want to, build cars here. We want to build our own, everything here. Move your factories back to the States. Don't build in China. Don't build in Mexico and think you're going to get into the United States market. We're going to put tariffs on it because you're using much lower labor, and we want to make sure that people in America get the good paying jobs. And so that's why we want these tariffs. For us in Canada, the manufacturing sector in Ontario and Quebec probably have more reason to be worried than the energy sector in Saskatchewan, Alberta, and BC, simply because the Midwest refineries that take our heavy crude and then create all the products that they produce, including gasoline, diesel, etc., they use Canadian heavy crudes. If there's a 25% increase in that, that means the price of gasoline to the consumer goes up by 25%. That doesn't do what Trump wants it to do. It's the reverse. And so the refineries in the Midwest, which got him elected, and Texas, which is also the Gulf Coast, which uses our heavy crudes, they used to use more Mexican and Venezuelan. Mexico doesn't spend enough money drilling to replace its declines, and so they're not growing. And of course, Venezuela is got a government that should not be in power because it's an illegal government because it didn't win the election. And of course, Trump probably will put pressure on Maduro when he gets elected. That's where the price of oil could go higher. There's two courses that where sanctions and more aggressive politics by the Trump administration could mean higher oil prices, not lower. One of them is, of course, embargoing Venezuela. And Venezuela ships, I got the number here, 876,000 barrels a day in the month of November. The other one is Iran, and Iran produced 3.32 million barrels in November of 2024. And, they could lose a million or two if there's an embargo and sanctions that are on a more aggressive stage under the Trump administration. So you remove, 1, 2, 3 million barrels from the capacity out there, and all of a sudden OPEC has the ability to, non-Iran OPEC has the ability to bring on some production. And that also means higher prices to attract everybody to spend money to bring on new production. So the geopolitics are positive for oil. The economic issues of, let's say, the tariffs are going to hurt countries where that are sending goods to the United States now. Germany with their cars, China with everything in Walmart and Target. That when you buy, if those 25% tariffs go on, those economies will be weaker. Canada as well, Mexico as well. And so if they're weaker, their usage of energy will go down. So that's the trade-off between Venezuela, Iran, where you sanction them, and then where you hurt them, others with tariffs. So to me, I think the tariffs are a negotiating point. He likes to throw mud in at people and then get them so nervous that they sit down and negotiate. And he may be really wanting them to spend more money on the 2% number that they talk about for NATO spending for military, and a lot of countries in Europe are not. Canada, of course, is not. So that could be one issue. The other could be the border, fentanyl crossing and illegal immigrants coming down. Canada's not the problem. It's the U.S. border with Mexico. That's really the one where the people are crossing in. But we do have problems for some that do get into Canada and then sneak into the States. So we're not totally without, the finger pointing at us. But to me, it's more the drug issue where the Canadian border is more porous. And of course, it's such a big border with not, and it's definitely not a border wall. So that's really an issue.
Okay. I think that really helps explain what's going on in the US. We've got this major political shift happening down there. I want to throw in, just because Canada has come up a couple of times, a question about Canada. I have to imagine up here that we are getting closer to a federal election, which also could change the situation for oil and gas in the country. Are you watching anything there? Is that going to be important in 2025?
Yeah, there's we should have a federal election, because of the NDP saying they're not going to support the Liberals, but the bloc would probably support them because they can always get a few more goodies for Quebec. So remember, I'm an Albertan, so there's a bit of cynicism here. But there's a G7 meeting in June of 2025 in Kananaskis, which of course is, the Banff-Kananaskis area. And so I think Trudeau wants to be on the scene as the prime minister still. So I think he's going to probably try to drag it out. And then the more cynical side of me says a lot of MPs, are vested for their pensions in February, but a lot of them aren't until early October. So the cynicism in me says maybe they're going to want to hold off until after that, call the election in October, which they're required to before the end of October, and then the election is afterwards, but the MPs end up getting their full pensions. So a little cynicism there, but I think a little truth to it, truth to that as well.
Yeah, very, very tricky what could be happening there. And if we go beyond North America, looking at the geopolitical situation, we still have the Russia-Ukraine war continuing, tensions in the Middle East ongoing as well. How do you see that weighing on oil and gas moving forward into next year? What are you watching there?
Well, the Middle East, in one way, Iran's proxies have been hurt. Hezbollah's gone as a fighting force. Syria, of course, Assad is gone, and Turkey really is the player now. Calling the shots more than the U.S. probably. Iran is not a power anymore. And then the ones that are still active proxies are the Houthis, who've been still sending missiles into Israel, and the United States are retaliating. There was an article this morning in the news that the Suez Canal, because of the attacks by the Houthis, Egypt has lost 70% of the revenues that they normally get for the traffic going through the Suez Canal. And that's a big money earner for the Egyptian, and the Egyptian currency has fallen to a significant low because of that, and their economy hurts because of that. So that's an issue. We know Trump wants to have a solution with the Ukraine issue with Putin. Again, it's going to require concessions on land, which Ukraine has said they didn't want to do, but it's, reality on the ground says it's not going to change. But I think that once we get to January 20th, I think that's when we start looking at some diplomatic action there. And I think part of it's going to be, the strength of Ukraine's position will be holding land in Russia, where they did that Kursk offensive. If they still control quite a bit of land, then they have a stronger bargaining position. I'll trade land for land, kind of thing like that. And then we demilitarize, the border. There's talk of maybe UN peacekeepers go between whatever the new border is between Ukraine and Russia. So there's a little bit of a buffer there to support Ukraine independence. So there's a lot of interesting issues. We cover that almost every week in our Eye on Energy. So people can just go to our website, eyeonenergy.com, and we cover the macro side, and it's a free product, like that four-letter word, free product that we do. And it's really for us to send out to clients what's going on geopolitically, macro for oil, and then the company stuff and the individual company research. That's where our paid product is. And so for people who want to get more familiar with oil and gas, and you're now on that list receiving it, you can just go to eyeonenergy.com and under our subscription page and sign up. And this way, every week you'll have something come in your in basket, which talks about the US EIA data, what's going on with OPEC, what's going on geopolitically, where do I see near-term price of oil going, how does it affect the investment market for energy stocks. But then we do not give any of the information related to specific energy stocks. That's in our paid product.
Yeah, I've been receiving that now for a couple of weeks at least, and definitely a wealth of information there. So we'll make sure to include the link for people who would like to sign up or learn more about that. I want to ask you a little bit more about what's going on with OPEC. So you talked about OPEC at the beginning and how production had actually raised over a particular period of time. I know that OPEC has cut its oil demand growth forecast for 2025 and delayed plans to restart the halt in production. So what is going on there? What key points are you watching when it comes to OPEC?
Well, at the beginning of 2024, OPEC expected the demand growth in 2024 to be 2.5 million barrels. But as we got through Q2 and they saw that the problems were happening with the US demand, they started lowering those numbers. And the most recent report shows that they're looking for an increase only of 1.5 million. I've been looking at 1.4 million for this year. So they've been bringing their number down as they're seeing the demand numbers weaken. They next year are looking for a number, I think a number was 1.4 million barrels of growth because they're seeing this sluggishness out there. I think it'll be a little bit better, 1.5, but the better comparisons will occur in the second half of 2025 as I'm talking about that $90 WTI price. So I think people should be watching what OPEC does, and the monthly report is there, and they can read about it in Ion Energy if they don't want to have to search the sources, and we cover what they're doing. But there's a mix of interesting things. Where the increase came this month was Libya was up 141,000, Nigeria was up, you saw Iran up 37,000, but you saw numbers like Iraq down 45,000, Venezuela down 20. So there's a mixture of what's going on there. Interestingly, Saudi Arabia was down 10,000, but they're still 8.96 million. If you look at the world, people need to understand this. The US is 13.6. They're the largest producer in the world. You then have Russia at 9 million barrels a day. Then you have Saudi Arabia at 8.96. Then you have Canada at 5.9. People don't realize how big a producer of energy we are on the liquid side. And so we are, and if people start worrying about security of supply, I don't want to buy from Russia, I don't want to buy from OPEC or Saudi Arabia, then they realize, Canada is a very, number one, hopefully it's a dependable provider of it. And of course, with, the TMX pipeline going through the West Coast, and of course, all the Enbridge lines and going down south and, the South Bow lines going down south. We have the ability to deliver oil down to the Gulf Coast now, and that can then be shipped to wherever, Europe or whatever. But there's no way we're going to get a pipeline to the East Coast. I think that's a dead issue. But could there be an expansion on the West Coast lines if there was a conservative government and if there was a government in BC that was supportive? I think, there's a chance for more export potential on the West Coast before the end of the decade.
Really interesting. And at the beginning of the conversation, you gave a really detailed look at your oil price prediction for 2025, quarter by quarter. How are you seeing natural gas this coming year?
That's a tougher one. Let me go through a little bit of global on natural gas. The highest prices for natural gas right now are in Europe because they've had cold weather and their storage has come down quite a bit and very fast. And so it's between US $15 to $17 per MCF for their TTF, as they call their pricing there versus, there's differentials names for each of them. In Asia, the prices of natural gas are 13 to 15 US. In the United States, they're 350, 360 right now US. And in Canada, we're $1.70, $1.80 Canadian for the Canadian domestic price. So we are the lowest price around there. For Canada, the cold weather helps. So if we have a very cold winter, prices both in Canada and the States will go higher. But the real thing is in the second half of 2025, the LNG Canada first phase comes on, and that will take about 2 BCF a day. That will tighten things up. We produce in Canada about 18, 19 BCF a day. So 2 BCF on top of it is pretty good. And then, of course, during the winter, we draw down the storage. So I think there's going to be better pricing for natural gas starting in the second half of 2025. What happens in the first half is weather related.
Okay, you're right. That is a lot more complicated. So thank you for going through that one.
Yeah.
So if we look forward, we've got all of this information about what is coming in 2025. And for investors, I think they hear this and they wonder, okay, so how should I position when it comes to the companies? And don't need to talk about specific names because I would think that's what you want people to subscribe for. But just in general, any thoughts on best opportunities in 2025?
Yeah, right now, a lot of the small and medium-sized companies, both oil and natural gas companies, are trading near their 52-week lows, and they're doing that because of people made a lot of money number one, they're down because of the lower commodity price. That's first, but the stocks are down from where they were at the beginning of the year when we were in the $80 number, because we're 70 something today, and the key is that. People who made money and book gains in, Tesla or Nvidia or big tech in Canada, or even the bank stocks in Canada did well. Wherever they booked gains, they're going to have to pay taxes to Ottawa in April for their capital gains. So what they do is they look in their portfolio with their investment advisors and say, look, you have a loss of, you made $20,000 gain in this tech stock. You've got a $12,000 loss today in this energy stock or material stock. Why don't we trigger that? That will then offset the gain you made, and you'll pay less capital gains tax, whatever the capital gains tax rate is, because we still don't know that from the feds what it's going to be. But that saves you from paying tax. So the problem you have is the institutional books are closed already, but individuals can sell until December 30th because of the 1-day settlement rule. So we still have 1 or 2 days next week, Monday, Tuesday of next week, where tax loss selling is still a lot, active. And I'm hearing from talking to companies where their stock is being beat, not because of this tax loss activity, that there still are brokers telling them that they have paper that has to be sold. And so that's why you're seeing, when you look at some of the quotes, they're not very pretty. So that's where I think from the people who know the stories, who do their homework, and again, I'll put an ad, a little marketing for us. We cover 38 companies between E&P companies, energy service, royalty trusts, and there's bargains right across the board. And if you read our Eye on Energy, you'll see that we have a holiday special on right now for people who want to take advantage of it. And it says it'll be till the end of the month, but we'll extend it because of this interview through the end of Friday of next week. So people who want to take advantage of the $100 off on the annual or $50 on the quarterly, if you want to just dip your toes in, go get the quarterly, see if you like it, and then switch to the annual. But I think people will find it very, very informative.
Oh, that's a great offer. Thank you very much. And okay, so that definitely now it sounds like is the time to be looking at this and maybe sorting yourself out a little bit for 2025. Just a little bit more on the company side briefly. I was mentioning to you that I see our audience getting a little bit more interested in the oil and gas side right now, although we focus a lot on mining. Are there any geographic areas that you like for companies? I think a couple of areas that we've been getting questions about are the Montney and Duvernay formations.
Yeah, Canada, people don't realize it, but, just like the Permian is such a big play for the U.S., our Montney Duvernay is a massive aerial extent with fabulous productive capacity. And we've got names like, Tourmaline's there, Paramount is there, ARC is there. So there's tremendous large names. Tourmaline's a 600,000 BOE a day company. CNQ is in there. They're all, everybody's in there. On the medium size, there's a lot of companies that are in there as well. You've got, names like New Vista. You've got, you've got names like Birchcliff. You've got others that are there. And then the benefit is you also want to be involved in the service sector, because if we're going to see better activity, the frackers like Trican and Step will do well. The drillers like Total, Ensign, Precision will do well. And then you want to be involved in the international side, because the size of the prize of many companies on the international side is significant. And so there are companies operating in Colombia, offshore Thailand, there's offshore Africa. There's a lot of places to look at. And when I've been through a couple of cycles, and maybe I'll just go over this macro piece here. We've really had a lot of trading markets where it was very hard for investors to make money unless you were very nimble and very, very in touch with the sector. But there are times when you have multi-year bull markets. 74 to 81 was one of them. The price of oil went from sub $3 to 36. It was the formation of OPEC. That's when we found the Hibernian on the East Coast. And so there was some massive upside there. And companies in Alaska were successful. Gulf of Mexico were successful. And then, of course, we went into a trading market because we had 1980-81, we had 14% interest rates on the long end, 21%, and central banks said this inflation has to be shut down, and they pushed us into a severe recession, and the price of oil went from 36 down to 10, and it kind of waffled around. War things would drive it up a little bit, but it wasn't until 1999 when China decided capitalism for the economy under a communist umbrella. And China was producing about 4 million barrels, consuming 3.5. And with the door opening for capitalism, their increase in consumption went to like 12, 13 million barrels between 1999 and 2008. That drove the price of oil to 147 WTI. And then, of course, we had the fiscal crisis, financial crisis of 08-09, which affected global economies, and the price of oil got hit again. And then, of course, we had COVID. And then March of 2020, I think, started the third cycle for my career. And I think this cycle will go till the end of the decade. So I think that anytime you see corrective periods like we are now, these are bargains. I'm taking advantage of it personally. In our reports the SCR reports, we disclose what we're doing. But we can't, until we recommend a stock, we can't touch it. We have to give our clients 5 days notice first before we can buy it. And if we want to say sell, the clients here first and then 5 days. Right now we're on the buy side and we're taking advantage of the bargains that are out there. And our clients will see that in our next January report.
Okay, very good. Yeah, and you touched on something that I wanted to ask you about, which is I know in your newsletter you've talked about how we're in this broader energy super cycle that goes to the end of this decade or so. So I think that kind of situates us. Are there any points that you would leave us with as we're getting to the end here? I think we covered a lot, but this is, I mentioned, a sector that's new to me. So anything else you would highlight for investors?
Yeah, what I'm looking at is a commodity super cycle because there's been underinvestment in it. So not only is it energy, oil, natural gas, but it's the raw materials, copper, nickel, aluminum, lithium, rare earths. All of these areas are going to benefit. So the other side of it, that you do your interviews, hopefully they'll all say, thank you. But the reality is all of the commodities have been underinvested in for so long that to bring on more production takes time. Building of infrastructure takes time. So it's going to be a massive cycle. And before this cycle is over, I think we're going to be above that 147 that we were in 2008. We'll get overheated again. So we're going to go now from fiscal discipline and shareholder returns and free cash flow to, remember in the old days, it was spend and grow without looking at the fiscal economics. I think by the end of the decade, we'll get stupid again. And that'll tell you when it's the time to sell. And people say to me, Joseph, how do you know when it's time to sell? Well, the key thing is some of the companies have very smart managers and owners. And Mike Rose, for example, had, Berkeley, sold it out. Then he created Duvernay, sold that to Shell. I think he sold the first one to Anadarko. He's got Tourmaline now. When he says it's time to sell, that will be the bell ringing for me. I don't have to be smart. I just have to watch the smart people.
Okay, I think that makes a lot of sense. All right. Well, this was really good. I think this is so helpful looking back at 2024, forward to 2025, and even beyond. Thank you so much for coming on to talk about what's going on in oil and gas.
My pleasure. It's good to be with you, Charlotte.
Really good to have you. Once again, I'm Charlotte McLeod with investingnews.com, and this is Josef Schachter with the Schachter Energy Report.
Thank you for watching. If you like this video, make sure you hit the like button and subscribe to our channel. We'd also love to hear your thoughts, so leave us a comment below.